Welcome back. We're gonna kick off with the chapter on annuity products, and we're specifically gonna look into life annuity products and also the differences between life annuity products and annuity certain products. So this is chapter 5 from our book, and like we did for the life insurance products, we want to understand how we should value such life annuity products. So first of all, a picture to keep in mind. So what is the difference between an annuity certain and a life annuity? So a typical example of an annuity certain is a loan, is a mortgage, like you did in the first assignment. So you've got there, for example, a loan, and you've got Mr. Incredible who's paying off his car loan by paying a certain amount to his bank every month during, say, 5 years or something, right? So that is an annuity certain because all these monthly payments during the period of 5 years, they should be paid back to this bank. There is no way that the bank will say, like, after 3 years or something, oh, we're done and the rest of the loan, we're gonna drop it for you. So that's an annuity certain. The duration is not stochastic. On the other hand, if you look at the concept of a life annuity, then the main example is a retirement plan, is a pension. You receive this pension every month from a certain age on, and you will receive it as long as you are alive, right? So the duration of the cash flow stream in this particular case is stochastic. It is contingent on the fact that you, as the policyholder or as the granted person, that you are alive. So that's the main difference. Deterministic duration versus stochastic duration. And with deterministic duration, you know from courses on empirical finance, you know how to value this cash flow stream. But when the duration is stochastic, then you'll need to come to an actuarial course like this one, because then you'll need to take into account what is the probability that I will have to pay this cash at a certain point in time to my policyholder, right? So that's what we're going to work on. So a life annuity, it's a series of payments to or from an individual. To an individual, think about the retirement, the pension plan. From an individual, think about the premiums that you pay. Premiums that you pay for your retirement plan, for example, during the period that you're active, that you're working, that you are employed, right? So we'll do the whole chapter 6 on premium calculation. So there we'll need this concept of annuities, life annuities, a lot and very intense, because that will be the way how to value this stream of payments that we're gonna pay, right? The life annuity is contingent on the individual being alive on the payment date. And the valuation of such annuities is important because they appear, like I said, in premium calculation. That will be the topic of chapter 6. Policy valuation, that's the topic of chapter 7. Pension benefits, pension, actuarial mathematics for pension systems. That's where this kind of things are also very important. I've got a sort of a visual to picture you the working of a life annuity. It's based on the book that we were previously using in this course, because you can picture the working of a life annuity in a very naive way as follows. You've got your policyholders, your annuitants. They put premiums into a box because you don't get this product, this life annuity product, for free, of course. You need to pay for it. You need to pay a certain premium for it. So our annuitants, they put their premiums in the box. That's indicated here with the blue arrows. And of course, our insurance company, our financial institution, can earn interest from the money, that's from the premiums collected from the group of policyholders. But they promise something in return. They promise, for as long as you're alive, we're going to pay you, let's say, every month a certain income. So we need to pay benefits out of this box. So there are two types of earnings that the insurance company will take into account here. There is the premiums that we pay as policyholders. There is the interest that the insurance company can earn. using the whole collection or the whole volume of premiums paid. But there is also something like the survivorship earnings. And what I mean with that is that, of course, certain policyholders, some policyholders, will die at certain points in time. And we no longer have to pay then the monthly income for them, but we did receive the premiums collected in their boxes. So we can use this premium volume from those who die early to finance the annuity payments for those who will live longer, right? Of course, there is a systemic risk in this whole setting here, and that's driven by the longevity phenomenon, the fact that everybody tends to, or no, not everybody, but the fact that on average, people tend to live longer. So that creates a pressure on the financing mechanisms of this kind of products. Okay. So mind the difference. It's very important. With an annuity certain, we've got a guaranteed series of payments, and guaranteed means here is to be understood as there is no stochasticity. It's a deterministic cash flow stream. And I picture that as follows. We've got a timeline. I've got a cash flow C0 that I need to pay at time 0, C1 at time 1, and so on. So here the cash flow stream has a fixed and known duration. Everything is deterministic. This is the typical corporate finance course setting, and how to calculate the present value of this cash flow stream. On the other hand, with a life annuity, we've got our dependence on the survival of the recipient. So in this case, for instance, if you look at the cash flow C4, which is to be paid at time 4, well, in that case, that would be the last cash flow that my annuitant receive in the setting, in the scenario that is pictured here on my graph. So here on my graph, my annuitant dies between time 4 and time 5. So that means he will receive all the cash flows up to C4, but no more cash flows from there on, because he's no longer alive. So here, the duration of the stream of payments is unknown and thus stochastic. So when we value this, we need to take probabilities into account. Okay, there is one other difference that I need to reflect upon, and that's the difference between an annuity due and an immediate annuity. So an annuity due works in advance, so that means that you pay the cash flow at the beginning of the year, right? So that's what you see pictured over here. I've got €1 that is paid at time 0, €1 at time 1, etc. If you look at an immediate annuity, you work in arrears. So that means you pay the cash flow at the end of the year. So you pay the €1, the first €1, right before time point 1. You pay the next €1 right before time point 2. So of course, this has an impact on your valuation formula, because here you will work with the €1. If you calculate then the present value of this stream, you've got 1 plus v squared plus v to the power 3, etc. Whereas here, if you calculate the present value, you will not start with 1, but you will start with v, then v squared, v to the power 3, etc. So this has an impact on your valuation formulas. So I put that here together. This is what you recognize or should recognize from empirical finance courses, etc. If we look at the symbol here for the present value of an annuity certain with a duration n, which is paid at the beginning of the year, so that's what the double dot refers to, that you're going to pay this annuity certain at the beginning of the year, and the valuation formula for the present value becomes this expression. So that's 1 plus v squared, etc., plus v to the power n minus 1. So that's exactly the setting that I had in my first timeline over here. If you calculate the present value of this stream of payments, you'll get the expression that I had on sheet number 8, right? And there's a symbol for that. It's the A, so small a refers to annuity, and with the angle, once again, refers to the duration. So in this case, it refers to, you'll have n payments in total. And the double dot here refers to the fact that you will start at the beginning of the year, that you will do the payments at the beginning the year, right? If the V is constant, if the interest is constant, and only in that case, you can rely on your formulas for the sum of the first n terms from a geometric series, and you can write down this P present value in the following compact way. But be careful, this only holds. You can only use this type of reasoning for a constant interest rate. And you know that that's not a very realistic setting in reality. If you are working with a changing interest rate, like you did in the first chapter of the data camp course, then you'll need to code or you need to write something in Excel or in R or in Python to do the valuation formula for you. Then you cannot get it as quickly as you've got it here, right? So this is annual, this is an annuity certain, this is working in advance. Well, I introduce a notation D here for 1 minus V, that's sometimes called the rate of discount. That doesn't matter too much, right? So be careful, this kind of summation formulas only holds if you're dealing with a fixed discount factor with a fixed interest rate. If you then look at the same type of formula, but now for an annuity certain that is payable annually in arrear for n years, so that means at the end of each year, then your present value formula is going to look like this, so V plus V squared and so on plus V to the power n. Once again, you can use your machinery from calculating the sum of the first n terms from a geometric series. You can use that over here as well. So do mind that I do not have the double dot here. That is to make the difference, the distinction between payable in advance and being payable in arrear as we have over here. Okay. The last one I want to show in my review is the continuous formula. So what if we replace this summation formula with an integral? We let the integral go from 0 to n. We do V to the power t dt. Then we've got the present value of an annuity certain that is payable continuously at a rate of 1 per year for n years. Of course, this is an artificial kind of product, but it's interesting to have it mathematically because you can see it as a kind of limit expression if the frequency of payments becomes very high, right? If you pay very often in this product. Do mind the notation now. Now we've got a bar on top of the small a, and that is once again to indicate the fact that you work with a continuous time product. Okay. The type of integral that I'm using here to come up with this expression, closed form expression for the valuation formula, that's the integral that you see here at the bottom. So you can use that to verify this expression yourself. Okay, we can do it monthly as well. And that's, I think, the last formula I want to review. So we're still dealing with the annuity certain reasoning. So what you see here is that instead of paying €1 at the beginning of the year or €1 at the end of the year, what we're going to do is we're going to pay 1 over m euro, and we're going to pay that m times throughout the year. And in this particular case, my first payment of 1 over m is at time 0. My next payment of 1 over m is at time 1 over m, then 2 over m, etc., etc. Right? So in total, you're going to pay m euros per year, but you're going to split it up in m payments worth 1 over m, and you either do those in advance or you do these in arrear. And then you get the present value formulas like you see over here. This was all for annuity certain. Any questions on those? This is meant to be like a recap of valuation formulas that you may have seen in other courses. There is no stochasticity here. It's just about the timing of the cash flows and then calculating their present value. And what we now want to do is we want to step from the annuity certain to the life annuity. And we're going to start with an annual life annuity, more specifically a whole life annuity due. So it's a whole life annuity, so that means it will continue as long as the policyholder lives. It's an annuity due, that means it's going to pay at the beginning of the year, right? So let's say we start with a life with an annuity of €1 per year, annually in advance. So it's annual, so it's discrete time, throughout the lifetime of my policyholder X. And we can reflect a bit on that. So we say that if X would die between ages X plus K and X plus K plus 1, then that means that the annuity is gonna pay at times 0, 1, 2, and so on. And the last payment will take place at time K. You see that? So K plus 1 payments in total. We start here with a payment at time 0 because this product, this specific example, is working in advance. So it will pay at the beginning of the year. Why is the last payment at time K? Because my policyholder here dies between age X plus K and X plus K plus 1. And we know that the life annuity stops paying if my policyholder dies, right? So what does that mean? In this particular setting, I've got K plus 1 payments in total. But what is this small k? Well, think about what we learned about the current future lifetime random variable, the kx. Well, in this particular example, this small k is the value that the current future lifetime, the variable kx, would take, right? So if you want to write down the number of payments in terms of a random variable, then in this particular setting, the annual setting where we pay in advance, there we have kx plus 1 payments, including the initial payment. See that? So the duration of our cash flow stream is unknown, it's stochastic. And in this particular case, we can express the number of payments that we're gonna do, we can express it through our current future lifetime random variable, kx. Does that make sense? So how does that help us then to come up with a valuation formula? That's the next thing we want to think about. So that means if kx is equal to k, then the present value of this particular annuity can be written like this. So what you recognize here is the valuation, the present value formula for an annuity certain with a duration k plus 1. So that means there are k plus 1 payments in total. It's discrete time and it pays in advance, right? At the beginning of the year. So it's an annuity due, right? So if you know which value your random variable is going to take, then you can write down the present value of this life annuity with one of these formulas that you know from what you learned on annuity certain products. So putting that together, we could say that the present value random variable of this whole life annuity due, say y, can be written as the present value of an annuity certain, but with an unknown, with a stochastic duration. And this stochastic duration, that is my kx plus 1. That's the number of payments that I'm gonna do in total. And then the second equality that you see over here is then borrowing from the formulas that I just reviewed about our annuity certain products. Because a couple of sheets ago, we said if you have an annuity certain, it works in advance, it has n payments in total, then the present value would be 1 minus v to the power n divided by 1 minus v. Well, here this n, this duration, is now captured by the kx plus 1. So that's how we can write down this present value random variable. Now there is one big assumption that I'm making here in order to be able to write down this formula. And could you perhaps help me in the chat saying some suggestions? What is the big assumption that I'm making? This formula that you see here on my screen, it's only valid under a specific assumption, namely, very good, set interest rate constant. Yeah, if your interest rate is not constant, then this reasoning does not hold. Then we will need an alternative reasoning. But if v is constant, then you can rely on your formulas like the ones that we used for annuity certains, the connection with the first terms from a geometric series, etc. Then this works. Voila, so that's my important bullet here. This only holds when the interest rate is constant. Sally, you've got a question?
Yeah, so when you have that a person dies between time k and k plus 1, is there still a payment at k plus 1 then? Although the person has already died in between.
So the last payment is at time k, but we started with a payment at time 0. So in total, we've got k plus 1 payments. And this n in an annuity certain formula, the n refers to the number of payments that we have in total. And in a product that pays in advance, the first payment will be at time 0, and the last one would be at time n-1 if you've got n payments in total.
Oh, so it immediately stops contract when that person dies?
Yes, because that's the condition. You can only receive the money if you are alive at a certain time point.
Okay, that does make sense. Thank you.
Yeah. All right. So here we are. Now, to continue with our calculation of the EPV, because we're not there yet. We don't have the expected present value yet. We've only got a formula for the present value random variable. So if you look at the expected present value, then if you continue on the reasoning that we just developed, then you would just have to take the expected value of the random variable that we came up with. So what we need then is our present value random variable was the guy here in the brackets. If we can get the expected value of this guy, then we've got the actuarial value of this whole life annuity due, right? The expected value operator goes through this expression that you see over here. So we're left with calculating the expected value of v to the power kx plus 1. And you should recognize that from the chapter on life insurance products, that is exactly the capital AX. That's exactly the actuarial value of a whole life discrete insurance product issued to an ex-year-old. So we've got here a connection between the EPV of the whole life annuity due and the EPV of the whole life insurance product. And that's sometimes often referred to as the so-called endowment identity. Then you may ask, yeah, why is it an endowment if you speak about the whole life insurance? Well, you can do something similar for endowment products, but let's not go into that. What about the variance? Same story. You've got your random variable y. The random variable y is a transformation of the random variable kx. So you're gonna recycle the formulas from chapter 4 to come up here with the variance of your present value random variable. Okay, so we can do it. We came up with some useful expressions, but like our colleague Zep indicated, this is all relying on the fact that we assume the interest rate to be constant. If we don't, if that's not realistic, or if we don't want to do that, then this reasoning no longer holds and we need to come up with something more creative. Yeah, so that's my job for the next sheet. So what will be this more creative way of looking at the valuation expression? That is by using a so-called indicator random variable approach. So what we're going to do is we're going to write down the present value random variable in terms of an indicator function. And this may seem a bit complex at first sight, but I've got here an indicator that's going to look at whether the condition between brackets is true or not true. And if it's true, then the indicator returns 1. If the condition between the brackets is not true, then the indicator returns a 0, right? So let's say that my policyholder dies at age x plus 3.5, right? So the policyholder dies before reaching age x plus 4. Then I've got in my annuity I've got a payment at time 0, hx, a payment at time x plus 1, time 1, x plus 2, that's time 2, and x plus 3, that is time 3, right? So I've got 4 payments in total in this particular example. And that will exactly be captured with this indicator formula that you see over here. Because the first formula is going to return a 1, right? So that's the €1 I'll get at time 0. The second indicator is going to return a 1, which I should discount from time 1 to time 0. So that's the V here. This indicator is again returning a 1. So that gives me a payment at time 2, which I should discount to time 0. So that's the V squared here. And this indicator is also giving me a 1 because my policyholder would live for another 3.5 years, right? So this is again a 1, payment of 1 at time 3, which I should discount to time 0. But from there on, all the other indicator variables will give me a 0 because my policyholder will not reach hx plus 4 in this example. So this way of writing down the present value random variable is valid, is correct. And why is it a more flexible way of writing it down? Because now if I calculate the expected present value, or if I work with this thing, I'm no longer relying on my summation terms for a geometric series. I can work here with a fixed V, but I can as well work with a variable V, with a term structure of the interest rates. So if I do the calculation, if I calculate the expected value of y, then the thing is to calculate the expected value of these transformations of dx, of the expressions, like what is this indicator with which it's a Bernoulli variable. It's giving me a 1 or a 0, and it gives me a 1 with probability TPX, the survival probability of my x-year-old beyond time t. So if I put this all together, I've got the following summation formula, and it's really this one that you should keep in mind because it's the one which does not rely on the geometric series, on the fixed interest rate. So this is the one that you should keep in mind for the whole life annuity due. You take the sum over k, v to the power k, multiplied with kpx. Yeah. If you would compare this to the EPV formula for a whole life insurance, then do remember for the whole life insurance, we had v to the power k plus 1, because in a life insurance contract, you always pay at the end of the year of that, of course. And in the life insurance formula, we had kpx multiplied with qx plus k, because there we needed to assess the probability that the policyholder would die between time k and k plus 1. Here, the only thing we need to evaluate is what is the probability that you will be alive at a certain point k, time point k. Yeah? So this is for the whole life annuity due. I think I've got the timeline pictured over here. So the whole life annuity due, it pays at the beginning of the year. I draw it in a bit more general way over here. So I've got cash flows C. They do not necessarily need to be €1. It can also be more general cash flow pattern. I've got my discount factors over here. The fact that I use the brackets here is to indicate that I would allow for a variable structure there. And I've got the survival probabilities, right? And if you then look at the international actuarial notation, so if the cash flow C is constant and equal to 1, if the V is constant equal to V, then this A double dot X refers to the EPV of your whole life annuity product, whole life annuity due product. Okay. And now what we can do is we can play with these products. We can pay at the end of the year, we can limit the duration, we can let the benefit change over time. We can do all the same kind of things like what we've been doing with the life insurance products. Yeah. Some pros and cons of the two valuation strategies that I mentioned here. The summation formula only holds with a fixed interest, as we elaborated on. The indicator random variable gives me a more general valuation strategy that is easily extendable to a non-constant interest rate setting. But of course, this would require a software implementation if I have this term structure of interest rates and if I want to be able to calculate this. Yeah. So in a nutshell, you could say that this one, the first bullet here with the indicator, that really stems from an era, a time period in which there was not much computer power available, and people needed really quick formulas, quick closed form formulas to do this kind of valuations.